Hi, welcome to the Fall 2025 It's Your Money and It's Your Estate workshop series, brought to you by our 501c3 nonprofit organization, Financial and Estate Literacy. Our mission is to empower you to take control of your finances, your estate, and your charitable giving decisions. For the past 25 years, our founder, Peter Kote, as well as our entire team, have been providing these free, unbiased, and accessible 6-week workshops all over Orange County, California, as well as online, to help you make informed decisions that align with your unique needs and values. Let's start the program. This webinar is the 5th session of the It's Your Money workshop series. The topic for today is equity and fixed income investing. Our moderator is Peter Kote. Our guest speaker is Mark Hebner, and this webinar is brought to you by Ronald McDonald House, Orange County. Enjoy the workshop.
Good morning. What happened to you, Mark? There you are.
I'm here. Hey, Pete.
Good morning. Good to see you.
Good to see you.
You are an amazing person. And what I mean by that is that you went from one field into another and you have been successful absolutely in both. Your Ask First form is online, so anyone who's interested can take a look at it. But give us just a little snapshot of your history.
So, Pete, I started off as a nuclear pharmacist right out of college. That meant we compounded radioactive pharmaceuticals, mixing a radioactive substance with a pharmaceutical, put those together and delivered them to hospitals and clinics all around the country. We ended up in about 35 cities around the country. My partner and I started that business, and then we took it public, and then we ultimately sold it. And I retired at the ripe old age of 32 after we sold that. And I looked around and thought, oh, what am I going to do now? And I spent a lot of time looking for a new company, but I forgot to pay attention to my investments. I had all this money and kind of left it in the hands of a broker at one of the major brokerage firms. And fast forward about 14 years, somebody, one of my friends was killed in a car wreck, and the widow asked me if I would help her with her investing. And I thought, oh gosh, I'm not quite sure if I can help you, but I've often wondered what my broker was doing, and you have motivated me to do some research. So I went to Barnes & Noble at Fashion Island. You may remember it was down there by the Daily Grill. All that's gone now. I'm dating myself. Walked out of there with 22 books on investing, started reading them and digging into them. Plus, I just finished my MBA not too many years before that. Put all that together and concluded there was a better way for people to invest, which was to invest in index funds. I created this website 1999, and today we're managing about $5.9 billion.
Wow. Congratulations. That's pretty amazing.
Thank you.
And we're going to talk a little bit more about IFA and the style of investing that you do. But first of all, IFA is a fee-only fiduciary registered investment advisor firm, correct?
That is correct.
So the only way you are earning money is from your clients.
That's correct.
You don't get any monies from any other source.
Basically anything that we would recommend to clients, whatever company would recommend, does not pay us anything. We're literally only paid by clients.
Okay. How much do you charge clients?
So we have a tiered fee schedule that starts off for the first $500,000 at 0.9% of assets, and then it tiers down from there. And so Across the board, we have a wide range of clients. Our largest client is $260 million. And so those types of clients have a much reduced fee. And then for more of the standard client, we're at about 0.9% of their assets
Do
annually.
you have a minimum?
We have a minimum of 100,000.
You have a minimum of 100,000. Uh, who do you use as a custodian?
So we use either Schwab or Fidelity to hold our clients' assets. The custodian, that's what that is. It's a nice, safe place for people to have their assets. And they basically assign us to be the advisor on their account, which allows us to place trades in there, and for us also to take fees once we submit invoices into Schwab or Fidelity.
Okay. You're quite unique in the sense that you have a very heavy internet presence. Talk a little bit about what makes IFA unique.
Well, after I read all those books, I thought, where on the internet can people go to learn about investing in general and really what's the optimal way to do it? And there really weren't any websites from investment advisors that explained the proper way to invest and contrasted and compared it with other forms of investing. And so I decided to use the internet as a way to educate clients around the world. Actually, that's what it is, but mostly here in the U.S. where we could advise clients. And I built out this rather large website that provided lots of information about indexing, about historical returns of indexes and funds, and just lots of information. And most importantly, once we get into this a little bit, what you'll see is that the main determinant of your return has nothing to do with you outguessing the market or speculating. It has to do with how much risk is appropriate. And so we developed a little questionnaire, a survey, kind of like your pop quiz, and we allowed people to input their information, and then we quantified those answers to determine how much stock and bond allocation would be good for them given that input.
Okay. And is your fees on an annual basis or is that a one-time fee?
That's an annual basis.
Annual basis. And so let's get into the program. And
Okay.
then I'm going to disappear and I'm going to be doing the chats, and Don and I will be coming back in and asking you questions and making sure everything gets covered. You're not in presentation mode yet.
Uh, is that?
Yes, he is.
Oh,
He is.
Here you are.
okay, good. Well, wait a minute. I think it's up there.
Uh,
All right. So why do I think that you will not disappear?
uh,
Pete and I kind of like to do this together. We have in the past. You're
I
welcome to
will.
continue.
I am here.
I'm happy to continue to do that. Pete knows enough about this that he can ask some good questions just in case you don't. So let's get into this because I've got a lot of slides, some of which I'll kind of jump past, and we can always go back if you have questions about them. So we're going to talk about really the two major components of investing today, which was in your little questionnaire: equities and fixed income. So I like to think of those as two buckets of money. Your equities are your risky assets, and your bonds or fixed income are your safe assets. And really, investing is about what combination of those two you have. And that combination is a reflection of your risk capacity, we call it. And so we're going to talk about that a little bit later also. So here's a little bit about me. You can read about that later. Oh, what happened? I lost my ability. There we go. So here's a little bit about our company. You may know the Atrium building there in Irvine. We're on the ground floor there. We have about 2,200 clients. And as I mentioned, our assets under management are about 5.9 billion. That makes us one of the larger independent registered investment advisors in the country. CNBC does a survey every year, and they don't look just at assets under management. They look at your record and a bunch of other things. But out of some 40,000 registered investment advisors in the current country, we rank number 52. And so we were probably 52 because they didn't quite understand the difference between active and passive since they're CNBC.
We're going to be talking about that a lot.
Yeah, CNBC, basically they exist because people want to go there and get clues as to where the next hot investment will be, which in fact nobody really knows. So we have a number of services. Here's a list of our various services we provide to clients, which we like to call our fiduciary wealth services. Wealth management is our main business, but we also do tax returns and we do financial planning, retirement planning. We help orchestrate pledged asset lines, which are a really important thing for a lot of clients. I don't know if any of you have a pledged asset line, but let's say you've got a portfolio and it has 40% capital gains in there, and then you need money. Well, you may not want to pay capital gains tax if it's in a taxable account on 40% capital gains. And so you can set up a line to borrow from a Schwab in particular. I think Fidelity recently set up something with this as well, where you can borrow on your account instead of selling your assets. College planning is a little tricky. The 529 plans are good, but we've surveyed all the various ones across the country and we have our favorites. Social Security optimization, charitable giving, we help with, and then estate plan analysis. And then we have a whole bunch of referrals down on the bottom for estate planning attorneys. We have them all over the country. You can select your state and it'll give you some suggestions. We have some referrals for insurance services, for life and for property, for health, a lot of those areas. And then we can help set up banking, checking, mortgages, trustee services, and credit cards. And those are through the custodians that we work with.
Mark, is this available only to clients, or can someone go on your website and
they can go on our website, so it depends which one of these you're talking about. We have retirement planning calculators they can do on their own. We have a number of calculators people can play with, but the pledge asset line, college planning is also a calculator they can use. And then the estate planning attorney referrals is a service under our resources tab. And so that's kind of it.
A lot of the services are available even if you're not a client of
That's right.
Yeah.
But Neil Rudder, you know Neil, don't you?
Yes, I do know Neil.
So Neil is available and works with clients that come from your organization. And if anybody has an interest in any one of these things, Neil would be happy to help you, even though you're not a client.
Yeah.
Anything else on that, Pete?
No, that's it.
So what do people hire us for? These are the main things. Is you need somebody, you should have somebody who is a fiduciary, somebody who understands all aspects of investing and has a duty to act in your best interest, even if it goes against their interest. I like that last part the best. We all have a little bit of a conflict in that, in our case, we want more clients. So you could consider that a conflict. But we have a duty, and the SEC basically audits us on these actions we take to make sure that they are in the best interest of clients. We select and we monitor various index funds and ETFs. We have an investment committee. We put out a report every quarter, comparing all the funds that we recommend to the universe. And if there's issues with any of those, we monitor them, we watch them, we consider replacements for them. We design portfolios also that are consistent with clients' goals and their risk capacity or tolerance. We also integrate existing holdings into portfolios. So let's say you brought in some stocks, you had Nvidia and you had Apple for a long time, or Tesla, and you have all these gains in there. Well, clients might have a targeted allocation of, let's say, 30% to large companies. Well, we can take those stocks and basically integrate them into the portfolio and show those as part of your large cap holdings. We have consultations on taxes, plus we have our own CPA in-house, and we can provide advice on the tax ramifications of your investing or your spending. Retirement planning, we have two specialists that are certified financial planners that help with the advisor and their clients in setting up financial plans through either Right Capital or eMoney. Those are our two favorite software packages that do financial planning. And that's a really important part of providing fiduciary guidance, is that we're familiar with your entire financial situation. And once that's set up, it makes it a great overview and a great way for advisors to get caught up. When they haven't spoken to a client in a while, they can open up the financial plan and there's everything. And it allows us to basically provide better advice.
Mark, let's go to the next slide.
Yeah. So let's talk about stocks and understand what's involved in a stock. Now, hopefully this is a little rudimentary for most of you, but what are stocks? It gives you an ownership in a company. When we go out to 401k plans, I like to say, hey, how'd you like to be a part owner of a major company? Well, the way you can do that is you buy shares in those companies. And that gives you a stake in the company. If you buy the stock directly, you actually have the ability to vote on various actions that are proposed by the board. The prices of those stocks can fluctuate a lot, and there is some sharing of earnings through dividends, but you have to be careful. Dividends aren't what most people think they are. If you have a $100 stock and they pay a $5 dividend, the next morning you have $5 in cash and a $95 stock. The regulatory agencies that are in charge of these brokerage businesses require that the company who issued a dividend, when they open up the next morning, the initial trading price is reduced by the amount of dividend. So you really didn't get anything extra from a dividend, and that's often a point of confusion. Over the long term, stocks have yielded roughly 10 to 12% over 97 years, depending on the various asset classes that you have. But on the negative is there's a lot of unpredictability and a lot of wild volatility in stocks. And so the educated investor realizes that that's part of investing, and they ignore that volatility. And the uneducated one likes to sort of play it and see if they can speculate and take advantage of that volatility and end up doing better than just buying and holding. We'll get into that in a minute. So there are a lot of different ways you can invest in stocks. Buy them individually. You can get a mutual fund, exchange traded fund. You can buy an index fund. You can buy an actively managed fund where you pay some manager to pick stocks for you, and then you can get a closed-end fund. But I can tell you, you can pretty much forget about the first two and the bottom two. You either want an exchange-traded fund or just an index mutual fund. And more, we have been moving towards the exchange-traded funds because of the deferred tax feature of exchange-traded funds. Market capitalization. So what's market capitalization? Well, you have the price per share of your stock, and let's say it's $100 per share. Well, then you got to go add up how many shares they have to determine the overall what's called market capitalization, or basically the total value of their company. So we have three general categories here. We have large companies, we have mid-sized companies, we have small, and there's actually a micro companies as well. And so you can see here generally the size of these, it's over 10 billion for large cap, mid cap are 2 to 10, and your small cap stocks are below 2 billion, and that's just a general estimate of the differences. A little more information there, but basically, one thing you need to understand about this is the larger the company, the safer it is. And that means when a company is safe, they don't have to offer as high a return to their investors. But if it's a small company and they want investors because they're risky and more likely to go out of business when they're small, they need to keep their price at a point that offers their investors a higher expected return.
Mark, on the previous slide, do these large cap, mid cap, small cap act differently at different times of the year?
Not with any predictability, no.
But they do act differently.
Well,
In other words,
so
if you
so
own large cap stocks, you would probably be a little bit more stable.
there is a little less what we call volatility or standard deviation among large caps than small caps, which is actually a measure of risk. So the smaller the company, the more volatile and the more higher range of outcomes, standard deviation, all measures of risk there are among small. And the mid is just in the middle of those two.
Thank you.
So now let's talk about bonds, the safe bucket. I told you there were two buckets that you could think of with your money, the risky and the safe, and safer. And so here we talk about bonds. Basically, bonds are a loan that you provide to governments, municipalities, corporations. You're loaning them money, and they've promised to pay you some interest. And at the end of some period of time, what's known as the maturity, they're going to give you your money back. And so you can look at what the interest is. That's your interest payments. Your the credit rating is how safe and how risky those bonds are. They're generally broken up into two categories. Those that are bonds of corporations, which are riskier compared to bonds of governments. And why are governments or municipalities, local or federal, why are those safer? Well, they have the ability to tax. If a company is not doing well, there's no one for them to tax. They just have to figure out a way to make more profits from their clients or from their business. So one of the advantages for many investors is they can get a consistent income out of these bonds. But bonds are really, I think about bonds in two critical manners. Number one, they reduce the volatility of your equity. All investors are sensitive to volatilities of the value of your portfolio. And because bonds have less volatility, they will reduce the volatility of the equities. And so it's a way to sort of blend the two and find a volatility that's right for you. We don't see a lot of advantages of individual bonds, actually. We really prefer and think all investors should use bond funds of one or the other, a mutual fund or an ETF, because it allows you to target your maturity and your credit rating and have a professional manager who understands bonds maintain the investments, and when those bonds mature, get them reinvested again, and lots of issues there.
Yeah, Mark, there's approximately 4,500 stocks in the United States. I'm using an approximate number.
Yeah, it's a little less today, but go ahead. Yeah.
What's the number of bonds in the marketplace?
Man, pop quiz here. I don't really know what that number is. I don't know. Could be more actually.
Yeah,
So
it's
we focus on bond funds instead of individual positions. So I don't really know, but I
yeah,
can tell you. Go ahead.
yeah, it's just multiple. I mean,
Yeah.
it's not even close to bonds. I mean, it's close to stocks. Um, are bonds easy to purchase? Are they as transparent?
Well, first of all, as I said, I think it's best for people to buy funds of bonds rather than try to purchase individual bonds. But they're not as transparent as stocks are, and so that is another issue. Today, so I don't know how many years ago, maybe 15 years ago, the transparency of bond purchases and sales was made better through some new transparent software that became available. But bonds can be a little bit tricky for people to move in and out of. You can go to the Treasury directly and buy federal Treasury bonds. But I really discourage investors from buying any individual investments of stocks or bonds because you can get caught up there. And when you do that, you're competing with a lot of individuals who know a lot more about those investments than you do.
Yeah, thank you, Mark.
So there are a lot of types of bonds here. And again, I'd like you to think about these in terms of uh, uh, mutualized type investments, such as an ETF or a mutual fund, rather than you trying to get in here and understand what government agency bonds you should buy. But these are the major categories. There's, of course, the U.S. Treasury bonds, and those are considered among the safest bonds in the world. And in fact, the 30-day Treasury bill is considered zero risk by academics. The risk level actually starts at the 30-day T-bill and then goes up from there. But as you see, there's a lot of different uh, instruments that the U.S. Government will offer. Then there are government agency bonds, such as Fannie Mae and Ginnie Mae. You have mortgage-backed bonds. That's good, got us in trouble in the 2008, 2009 period with a lot of risky mortgage-backed securities. Then corporations will issue bonds. And finally, local governments and state governments will issue municipal bonds. So the municipal bonds have some tax benefits for local residents, but it's really a benefit for the issuer in that they don't have to pay as much tax or much interest to the local residents. And as a result, they offer a lower rate, and they can do that because the interest is tax-free to local residents. But I always like to remind people there's always two sides to a transaction. People like to say, oh, I get municipal bonds and they're tax free. Well, the reason that really is they want the issuers of those to get a break. And so they are able to do it at a lower interest, uh, issue these bonds at a lower interest. And so uh, you get, you end up with very close to a risk adjusted taxable bond return because there's more risk when you concentrate in a regional area such as a state or a city. Okay, so we were talking about this earlier, and a little questionnaire, which, by the way, I was quite surprised that 50% of these people had an 80-20 portfolio. And one thing we didn't ask them is how many that are 100% stock, Pete. We may want to ask that later, but my guess is if, did that even add up? Oh, it was pretty close. It looks like maybe 10% um, might have been, no, actually, that's 30, 50. That did get them all. Well, those are the ones who answered, but some people may not answered the survey. But anyway, so this is most important part for you as an investor is to determine how much risk is appropriate for you and basically how much you have the capacity to hold on to. And in doing our little questionnaire, we take clients through 5 different areas and we measure what would be how their answers impact their risk capacity. And then that comes up with a score between 1 and 100, and the number has to do with directs you to a portfolio that includes that stock allocation. So if you scored an 80 on that survey and half of you are in a portfolio 80% stock, we have a portfolio that's 80% stock and 20% bond.
Let me add the obvious question, Mark. Do you have to be a client in order to take the
No,
risk survey?
you do not.
It's a great little tool
Yeah.
because most people don't know where their own risk analysis. It's one of the hardest things to determine.
It really is. And we have had the benefit of, I couldn't tell you the exact number. If I was to guess, I don't know, at least, I don't know, 700,000 people have taken our little questionnaire, many of which are not clients. We have roughly 2,000 clients. And so we get people taking that questionnaire all day long, and many of them we never hear from, or they like Mickey Mouse. He loves to take our survey, Pete. He keeps coming back and taking it. I don't know what kind of portfolio Mickey's got, but
But there's two major investment philosophies. I know what side you're on, but talk about both.
yeah. So first of all, a lot of people like to say, well, I believe this and I believe that. This is a question of really understanding what I like to call the science of investing, the statistics of investing. And once you thoroughly vet all of that, there really is only one side to this, and there's really not any role for an active type investing. And there's Nobel Prizes, a lot of them, that lead you to this direction. But let's just talk about that. The first one is what we call an active investor. And what are they doing? Well, the primary philosophy behind active investing is that somehow the market, that's about 10 million traders a day, 5 million buyers and 5 million sellers, somehow this market of millions and millions of people have arrived at a price for these securities that is either overvalued or undervalued. That is the really foundational premise of active investing. The passive investor says, well, neither one of those are the case. We think with all of these human beings bringing their information and their forecasts to these trades, and there's about 10 billion shares traded every day, that when they bring all that information to the trade, they arrive at the correct or the right price, not the high price or not the low price, but the correct price. And the function and really the job of prices is to establish a fair expected return, which is commensurate with the risk of the investment. So those are really what's going on. And so what this says here is the active investor is trying to find a way to beat a market. Well, think about a market really as a risk level. And we could call that large companies or small companies. And depending on which group of those you're investing in, there is a market. So in small companies, it's the Russell 2000. Many of you may have heard of that. For large companies, it's typically the S&P 500. So we're going to take a look here to see in just a minute how these active investors do relative to those benchmarks. They're basically called a benchmark. So here are the primary principles that we utilize in our investment strategy. And just about every one of these come from some major academic research, and in many cases, they have to do with a Nobel Prize in economics. This is one of the first things that hit me, Pete, when I first started digging into all those books I was telling you about, is there were academic research papers out there that were peer reviewed, their statistics was checked. Peer reviewed means there's like 7 or 8 other academics who are checking your work and challenging your assumptions before those papers are published, like in the Journal of Finance. And so when you draw your conclusions from peer-reviewed research instead of what Barron's or Motley Fool or Investor Business Daily have to say every day, you have greatly elevated the quality of the information you're using to make your investment choices. So, number one, markets tend to reflect all available information, and they do it in a very efficient way. I would take the word tend out of there. I don't know who put that in there. They reflect all available information, basically. And this is Nobel Prize winner Eugene Fama's conclusion, which really went back to 1970 when he wrote his landmark paper on what's called market efficiency. Markets are very efficient at aggregating all this information and reflected in the price. When that's the case, risk and return are very closely related. Your returns are just a reflection of risk, and that's why that risk capacity survey and your asset allocation are so important. In fact, it's really pretty much the only thing that matters, as long as you're considering these next few factors, which is being highly diversified and paying attention to your low fees and your low taxes. Number 4 is that allocation, which is basically the amount of risk you're taking. And you want to be passive. That means you want to diversify over stocks, over time. And time means you're going to hang on and collect a lot of samples of daily, monthly, annual returns. And the more of those you collect, the more the higher the probability that you will capture a return that's appropriate for the risk you take. Man, we should have recorded that one, did we? We did. That was a good one, Pete.
Yes, we recorded it. Talk a little bit about benchmarking, because when you say beat the market or someone beats the market, what are you talking about?
I'm going to flip you a quarter for that one. You just set me up really good for this next slide, Pete.
Okay.
So the short answer to your question is you find some risk benchmark that comes closest to the types of stocks that somebody is buying. So this chart here shows us 6 different benchmarks or categories of companies, and I'll try to specify some of these benchmarks as we go through these. Now, this is one of my favorite charts because I think it's most similar to what the majority of investors on the active side are using to determine where they should invest their money, including a lot of quote unquote professional investment advisors who are scanning the universe of stock pickers or mutual funds or ETFs that are actively managed and trying to decide where they should recommend, what investments you should recommend for you. So let's start at the top. So one of the things I put in place 26 years ago when I started this company is every chart should use the same color coding, should have the same formatting, should have a title and a subtitle where we try to best summarize what the chart has, and then we give you a time period that's in this particular chart, and then a legend where appropriate. So what this one's called, which is so important for you, is the persistence of outperformance by what I'll call the stock picking managers, actively managed funds. And persistence is really important because it makes you think about, well, maybe in one period they just got lucky. And if they do it in 2 periods, well, then maybe they have a skill. And that persistence is something that we're all looking for among these stock picking or active managers. So let's see what happened. If it's blue, that means they outperformed their benchmark. And to answer Pete, if we're looking at large cap funds, the typical benchmark there is the S&P 500, the 500 largest companies in America. It's not exactly the largest. The Russell 1000 are the absolute largest, but the S&P 500 are the companies that represent the largest companies represent some 30 industries, and the U.S. is selected by the S&P committee. When it's orange color, that means it underperformed its benchmark. And if you just kind of step back, you see a lot more orange than you do blue, and that should give you a clue. And then the little call out box is the second period where we look at the persistence of outperformance. So let's start with large cap funds, 938 of them here. And we see that out of that 938, in the first 3-year period, and I said this is most common, I would think most investors say, well, if it was good for 3 years, it'll probably be good for me. Well, look at this. Only 10%, 10.5% of funds, or 99 out of 938, beat their benchmark in the first period. Now, what most people would say, well, tell me who those are. In fact, tell me who the best one was. That's where I want to put my money. But this is Standard & Poor's down here is where this comes from. They tracked those 99 funds in the subsequent period. I wish I could hear everybody. Pete, well, maybe you could tell me what percent of those funds continue to outperform that S&P 500?
Not many.
No, better than that.
None.
Zero. All right. Well, how about large value? So you were asking about benchmarks.
Yeah.
For large cap in the Russell, for example, there's a Russell 1000, and then they have a value filter. So here's now 310 stock pickers compared to the Russell 1000 value. Only 15% outperformed and zero continued to outperform. Small cap value, zero, 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 only a little bit in the small cap. Go ahead, Pete. I just want to finish that up.
Yeah, in the mutual fund world, and I think Morningstar would probably be your best source.
Yeah,
Each mutual fund has an investment advisor, and the investment advisor of that mutual fund has a investment objective.
that's
And
right.
so it'll state in that objective, I invest in large cap stocks. And so you can then compare the large cap stocks with an S&P 500. So there's mutual funds that specialize in small cap stocks. And that's where these statistics come from, is from these active managers who invest in that particular marketplace. And there are index funds that correlate to that that they become the benchmark because they're basically buying all the small caps or a majority of the small caps. Is that a good explanation, Mark, or should I
Well,
please
have you looked at
elaborate?
have you looked at this chart before, Pete?
Yes.
Okay. So what you say is supposed to be the case, but as it turns out, in their prospectus or in Morningstar, they may state that they're going to invest in large cap funds.
Yeah, there's
But
style
as it
drift.
turns out, in this case, 40% of those funds who stated they were going to buy large cap drifted outside of large caps. In the mid cap category, 58% drifted and invested outside of their stated benchmark. So this is another problem. It's one of the reasons it's one of my 12 steps. This is such a big issue. Look at among global equity funds, 78% did not invest in what their prospectus said they were going to invest in.
Yeah. One of the questions was, what is a value fund?
Yeah,
And I see an immense amount of drift in that category as well.
yeah, lots of drift. Yep.
Yeah. So what is a value fund? When somebody
So
says my goal is, or my investment objective is to purchase value stocks.
yeah. So the simplest way to think about value is basically the companies are cheaper than growth. And so, what's cheap relative to? Well, accountants determine what we call the book value of corporations. Most individuals can relate to book value as to the equity in your home. You have the value of your home, which you can dig up on Zillow, and then you have your mortgage. And then the difference between those, that's your debt, is a mortgage, right? Is the equity in your home. Well, companies also have an equity. They have the price they sell at, their market capitalization, and then they have the company's book value that an accountant determines. And the difference between those two is known as goodwill, actually. And the bigger that gap, the more growth stock they are. And the smaller the gap or the price is closest to the book value, the more value they are. And so we think of value stocks as basically being cheap and growth stocks as being expensive relative to the book value. And while we're on it here, this is a very important chart, another Nobel Prize for Eugene Fama here. If we were to
Can
look,
you enlarge on this a little bit?
yeah, we'd be happy to. We can do that.
Here we
That's how we go
There
here.
we go.
So if we look at value stocks versus growth stocks, let me get up here. In the US, all the way back to 1928, 97 years, we can see that value stocks have had returns of 12.7% versus growth stocks at 9.8. And remember, you were asking about the risk of small versus large. Well, this little SD stands for standard deviation. And here we can see small and value stocks are riskier because they have a 24 standard deviation small, where large is only 18. And value has a 25 standard deviation where growth is only 18. But guess what? Risk and return are related. And it's so beautiful to see this over large samples of time. In short periods, you don't always see this. I can show you that. That'll be my next chart. But this is really important that you understand these differences. And so that is the way this is measured, a value. It's actually the book value divided by the market price, book to value, book to market, they call it.
If somebody wants to learn more about this, what would you recommend?
I'd
Famont
recommend
French?
they call Neil.
Yeah, I know that. If they want to
Listen,
read some
listen.
books. Somebody wants to read some books.
So I have a book. My book is really the best source. I read. I have 2,500 books in my library. You've seen it,
Uh-huh.
Pete. And so I haven't read every one of those. I have to admit, but I've summarized many, many books. I don't know,
Okay.
a
If
couple
somebody
hundred
wants
books.
your book, how do they get your book?
Go to Amazon, and it's
Go to
called
Amazon?
Index Funds. Put in there Mark Hebner. We get it. Or actually, better yet, for your crowd, just
Uh-huh.
call Neil, and he'll send them a free book.
Okay, there
All
you
right.
go.
Or call you, you'll get them a book somehow.
Okay.
Okay. So these five factors. So number one is you need to know how much risk you take. Number two is this defines these risks for you so that you can put together an allocation of indexes, which is the only thing you should have in your investments, by the way, just these indexes. And you can see US, international, emerging markets, and these gray bars were identified all across here. This is just stocks versus T-bills here. But these gray bars were identified by Fama and French, and there were other academics that contributed to all this. And those are the areas that should have the higher allocation. So more small than large, you still have large. More growth than value, you'll still have some growth stocks. Profitability and investment are two other factors here. And so you want to emphasize these, and that's what we do. And we work with the company where Fama and French help design those indexes, which is called Dimensional Fund Advisors. So that was your question about benchmarking, or about value and how it's calculated.
Yeah.
Let me give you an example of when two indexes, so this is the other thing, not all indexes with the same name are the same. And so I love this chart. It just really just some examples. It could be a lot of different companies out there. But we looked at two, let's say, two companies that provide passive investing. One is Dimensional Funds, one's Vanguard. Everybody's heard of Vanguard. Not many people are familiar with Dimensional Funds. And really, I kind of created my company, Pete, to educate people about this chart, about the differences in indexes with the same name. So Vanguard versus Dimensional, almost 26 years now that we've been tracking this data. And it goes back to pretty much when I started my company. And let's look at these two. So this is the growth of $10,000 over this 26 years. The blue bars here are Dimensional and the burgundy are Vanguard. That's their colors. And we first see here that Dimensional charges 0.31 and Vanguard's only 0.07. Well, you're going, gee, give me that cheaper small value index. It must be better. Well, I just showed you the chart that more small meant higher returns. Well, look at here at Dimensional, they're small. This is the average market cap is 3.5 billion, but at Vanguard, their index construction rules, I want to make sure you understand that, they're different. And so their small is 7.6 billion. Their book to market ratio, which is the measurement of value that Pete was asking about, is close to 1, which means you're buying the companies at their book value. Warren Buffett and his mentor, Benjamin Graham, would love that. They're value investors, okay? But over at Vanguard, this is like 1 over 2.5, right? You're paying 2 times the market, the book value and the market price. So if the book value is $10, the market price of these stocks are 20. And so you're at 0.5 versus 1. These are major differences in the design of the indexes. And you can see the results here. More small, more value, higher historical returns for the last 25 years. Now, just to check this, what if we have 2 large blend funds? These are 2 S&P 500 funds. One from Dimensional, one from Vanguard. Look at here, market caps are the same, 400 billion, 400 billion. Book to market are the same, 0.2, 0.2. Expense ratios are very close. What did you get? The same return, or very close to the same return. The little higher fee meant Dimensional did a little worse. And in fact, we don't use Dimensional for their S&P fund. We actually go to Schwab, which is even less expensive than Vanguard. They're at 0.03. So really, really important chart. One of the most important charts I'm going to show you today. Because the expertise, let me finish this, Pete, real quick. Okay. The expertise of your index selector, your advisor, is really critical so that you maximize your return for the risk you take. Go, Pete.
You just pointed out 2 major issues. That is, you can control your cost and you can control how you invest in the market. For
the asset allocation.
For most individuals, Vanguard is probably better than 90% of the mutual funds out there.
I would agree.
But there's even better ones, and you have pointed that out in certain categories. Dimensional funds is one of the best.
Yeah.
And I think that's why this is so valuable, that you need to know and get into the nitty-gritty of these investments, because it really pays off in the long term, and that compounding. It's right. Every little fraction of cost savings adds to your final return.
Absolutely. So we beat up on stock picking. I hope everybody will go home and sell all their individual stocks, unless you got big capital gains, by the way. Again, talk to Neil. Neil can look at your portfolio, try to figure out a way to reposition it so you can get it in alignment with science and academic research. But you shouldn't be buying any more individual stocks, individual bonds. You want these highly diversified passive portfolios, and you shouldn't be trying to time the market. The 2 classic active strategies is picking stocks and timing the market. Look at this chart. This is one of our newer charts. Again, data coming from Dimensional Fund. I wish I had a nickel, Pete, for every time someone told me, oh, I can't invest now. We just hit a market high. Or the market's down and they say, I don't want to invest now. I don't want to grab a falling knife. This market's going to go down more. Well, look at this incredible chart. This takes a look at investing in at the top of a particular point in time. This goes back to 1926 for the S&P 500. And so we were tracking what happens if you invest at the top and what happens if you invest after a 10% market drop. 10% is a pretty good drop because the average return in a year is about 10%. So if it's down 10, you're getting a little nervous. So check this out. 1 year later, or 12 months is really what this amounts to, after we hit a new high, the market had a return of 13.7%. The average is 10. 1 year after a 10% drop, you had 11.7% return. And then if you take a few of those years and kind of average them out, look at this, 3 years after, either a high or a low, you got the same darn return.
I know, but to see, the thing of it is that investing is not just intellectual, it's emotional. And so when your emotions run high, you're going, well, you got to buy low and sell high. And so when the market is at the top, people get scared. They psychologically, it's hard to invest at the top. But
So it sounds like you need an expert, Pete.
yeah, you do. You can't. But that's why I don't manage my own money, Mark.
That's right. That's right.
Because it's too emotional.
Very
So,
emotional.
and so you have to tell your advisor, how long do you plan? When do you want to use this money?
That's right.
It's a
That's part of
very
our
key issue.
questionnaire. Yep, that's the first question in our little survey. Yep. So, but that doesn't affect whether you're going to be stock picking or market timing.
Sure.
When you need the money is an impact on how much bonds you should have in your portfolio,
Yeah.
basically,
Well,
because we want to
I've heard the
fund.
same.
Huh?
I've heard the same comment that you have. The
Yeah.
market is a little bit too high for me to invest
Oh
today.
my God, I heard it 100 times.
Yes, same here.
But if you think about it, if the market has gone up 10% a year for 97 years, how
Yeah.
many market highs are in there?
Yeah.
I mean, the average monthly return, what is it, about almost 1%? So 0.8, 0.9. So it has to be at a market high every so often.
Yeah.
All
Or
right.
I'm
So,
70 years old. I don't have time to go into the market.
yeah. So let's see. We did that one. I'm going to skip some of these. This is the market timing. This is another strong market timing chart. If you go back and look over 20 years, there's 5,000 trading days here. Because the highest returning days are about, I don't know, 3%, something like that, and it only has an average of 10%, 3 days a year, maybe four if they were 2.5%, 3 to 4 days a year make up your entire return. So if you're trying to time when to be in and when to be out, it's almost impossible for you to make sure you capture those 3 or 4 days that make up the entire return. So this really drives this point home. If over 20 years you missed 40 days, only 40 days out of 5,051 days, your $1,000 is basically still $1,000. This is what happens to $1,000 over that period. And so that's brutal. That only 40 days. And here's 20 days. That's 1 day a year out of 20. Your 1,000 only grew to 2. But if you just bought and held that S&P 500 for that 20 days, the $1,000 grew to 8,500 in this particular 20-year period. So
That's why
this
it's
is
so,
brutal.
yeah, and that's why it's so important to have the appropriate asset allocation that you can go through the rough times.
Yeah. So when we talk about stock picking, Pete, everybody says, well, what about Warren Buffett? Why can't I just invest like Warren Buffett or just buy Berkshire Hathaway? Well, let's take a look at Warren Buffett. He has a 44-year track record. Here's the total. You might know right away where I'm headed by looking at those green bars. That's when Warren did better than a large value benchmark. But the way I like to think about this is let's take his period and divide it in two. And let's go back in the way back machine or the time machine and assume that we're looking at investing in Warren Buffett in 2002. That's the end of the first period. Well, we look here and we see that he has beat the market. That's what an alpha is. It's the excess return over his Russell 1000 value benchmark. It was 16% a year for 22 years. Now, hardly anybody can resist saying that man is a genius. And if I invest now, I'm going to get something like that over the next 22 years. Well, you'd be wrong. Here's what happened in the second half of Warren Buffett's trading record, in his price record of Berkshire Hathaway. That excess return dropped down to 0.6. And you can see if you're paying for advice to do this, by the way, the 0.6 is wiped out. And it has this huge volatility. His extra return has this massive up and down. Look at this, 3 down, 3 up, 1 down, 1 up, 1 down, 1 up. You can see lots of variation and basically uncertainty of him doing better than just a simple, cheap index fund here. And then this last thing, this is a measure of luck. If this number, this T statistic was greater than 2, we would be pretty confident he has skill. But even that doesn't always work, because here that T stat was 3, way in excess of 2, which would indicate, wow, there's massive skill and brains here in the Oracle of Omaha. But turns out it's not the case either. So I hate to pop that bubble for you, but please don't bring up Warren Buffett in your questions. What about Warren Buffett? I get so sick of hearing that. Okay, so this is another Nobel Prize for Harry Markowitz. The light bulb went on for Harry and sitting at the University of Chicago Library in 1952, which was the year of my birth. And it's why it's my destiny to bring this to you. Now, and Harry says, hey, we should think about investments from 2 parameters, 2 various components. One, a long-term average of its return. And along the bottom is a long-term uncertainty of that return, the volatility, which we just saw with Warren Buffett, by the way. And this is quantified down here as what's called the standard deviation. And think of deviation as how much have those returns deviated, gone up and down relative to the average. And so that is basically a measure of risk. And a couple of little really important things up here. There are no investments up in the corner here where they have returns of 16% with 0 risk. That would mean 100% certainty. It doesn't exist. If you want to set your portfolio up for greater returns, what you see here is they're only available as you accept more uncertainty of those returns. All right. I don't know how we're doing on time here, Pete. Anything?
We're doing very well.
Oh, we are. Okay, good.
We have about 10 more minutes.
Okay, good. So, and do we have some questions yet?
We're going to have questions at the end, and
okay.
So you tell me when you're ready to close it up.
All right, good. So here's what I want to do. So I told you here that if you invested in small, or that you should invest some of your money in small caps and value and some of these and stocks and all these various factors. But then that brings up the question, this little standard deviation here brings up the question, how likely is it in different time periods that I would actually get those excess returns, what we call a premium, okay? So let's look at that. First of all, if we consider just investing in the stock market versus owning treasury bills, remember that's 0 risk, what is the likelihood in a 12-month period that stocks will beat T-bills? And I say the likelihood because will beat because I'm going to start off by giving you the information from 1927 until the end of last year. Anyway, on 1-year holding periods, it's only 70% of the time that the market has done better than T-bills. So 30% of the time you were better off sitting in stocks. Well, how about for value versus growth? Lately, we've seen a lot of, appears to be a lot of growth winners. That isn't even true. In the last 5 years, you were better off in small value than large growth. But in 12-month periods, only about 60% of the time, 59% of the time, has value done better than growth. But we'll see how these grow over time. And in 20 years, 100% of them were better off in stocks. And in value for 20 years, 94% of the time in the past, value has done better than growth. Down here, the 20-year period for small companies, it's been 93% of the time, but in 1 year period, it's only 55. And this is a source of confusion for all investors because down here for small, for example, 40% of the years, you're going to see 4 out of 10 years, you're going to see the opposite of what I told you or what you expected. And this leaves people with lots of confusion, and it drives home the point that basically from one period to the next, you are basically just looking at coin flips. And if we have just a couple more minutes, I want to show them my amazing new coin flip chart, which you haven't seen yet, Pete. You're going to love this deal. Let's see, get that over there. Can you see my coin flip now?
I see the coin flipping versus actual market returns.
Yeah, is that the, okay, that's not the one I want to show. Don, what do you see? Let's see, make sure we got equity. Which one is it? Oh, it's this one. I got it, sorry. Now we got it. I'm moving up and down, right?
Yeah.
Okay, good. So let's see if I can do this pretty quickly. We wanted to test to see if markets, any kind of market you want to pick, we have here all of our portfolios. We've got large companies, small companies, value companies, lots of different choices here. We wanted to see if those markets actually flipped up and down like a coin. And one way to do that is to take a coin and compare it to the market. And if we were going to do that, we would need to start with, well, what if I just had two coins instead of the coin in a market? And I flip them, what are the possible outcomes? And so here I can see if I have two coins, 25% of your flips, you should get two heads, 25% you should get two tails, and 25, the expected here, you should get a head and a tail, and 25% you should get a tail and a head. Okay? People forget about these bottom two down here, right? And when I just flip this, I'm going to flip it again here. Look at that. Wow, I got it exactly right. 1620, 1620, heads, heads. So the expected was what I observed in that last flip. But over here in the tail side, it wasn't exactly. I got 1600 versus 1620. And so you get a little randomness when I flip two coins, right? So I hope everybody's understanding that. I'm now going to move over and show you what was the most common portfolio, 80. So this is 80% stock and 20% bond. And if I were to look at the last 6,451, this includes yesterday, by the way, trading days, the average return, this is actually what we call the median, so it's the middle data point when you sort from high to low, was 0.066% per day. So we're going to call it a up return if you're above that, and a down return if you're below that, okay? Now watch, I'm going to flip the coin, and I'm going to flip the market over this 6,000 days, and look at this. We got almost exactly 25% versus 24, 25 versus 25.5 in the two downs, and it worked out to be almost precisely matching the two coins. So here's now in bar charts, head, head, tail, tail, head, tail, head, tail, head, up, up, down, down, up, down, down, up, all 25% because I ran 1,000 trials of these 1,000 flips. Now you might think maybe that's a daily outcome. nothing up my sleeve, but I'm going to switch to monthly. The monthly medium is 1.2% for that portfolio 80, which is half of you. I expect 25%. The coin gives me the total randomness, and the coin market tests the randomness of the market. And we see once again 25% in each one. And so I have now confirmed that the ups and downs of the market relative to a median return are a coin flip. Now, I just want to show you how random things are, even in looking at 97 years, okay? I'm going to flip the coin 97 times, the two coins, and look at these wild differences I see when I have such a relatively small sample. But this is one of the biggest problems for investors. They're looking at 3 years of returns. It's nothing. Here's 97, and even two coins, I don't get my expected in each bucket. And when I put coin versus market, I kind of get the same thing. Let's run this trial again. Look at these wild differences that are reflections of randomness. Wow, look at that one. We're up here 35% in tail. So here's what happens to the active managers, Pete. They take this and then they craft up a story as to why that happened and how that's going to impact your future investing. What a bunch of nonsense. Now I'm going to run them 1,000 times and you see it's exactly the same. The market is flipping up and down like a coin. And if you didn't understand what I said, here's all the data. You can flip through it. You can get right to the median return. This is one of the most amazing charts in investing ever created. And it might be my Nobel Prize, Pete.
Your point is that active managers is equating it to a coin toss.
Well, them trying to forecast what's going to happen, they're basically forecasting among coin flips.
I see what you're saying. Yeah.
Yep. Relative to the median now, right?
Yes.
So up or down relative to the median.
There's very few managers out there that beat the market consistently. And
well, I just showed you it was zero.
They got lucky.
That's what that persistence chart shows you over the 2-3 year periods. That one's brutal. Come on.
Yeah, I agree. All right. Let's open it up for a Q&A. Go ahead and put your chart away there, Mark.
Well, I might need to answer some questions for this.
Okay.
We got the whole website up here. I'm just going to click around while we're waiting for some things. We talked about the risk capacity survey a little bit. You tell me when you got a question.
Mark.
Sure.
We got 2 minutes, so please turn off your share screen.
Oh, okay. We can turn that off. There
Thank
we
you.
go.
And
I see no questions coming in at the moment, so I just want to make sure that we do one thing here, and then I'll turn off the recording. So, Mark, thank you very much. Pete, thank you very, very much. This has been equity and fixed income investing for It's Your Money. Next week, we will do financial planning 2. But I thank you very much, and we'll keep on going but a moment, but I'm going to turn off the recording. So hang on.